This is ShadowQuant Stocks, brought to you by AresLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Wednesday, July 15, 2026, and this is the After Hours session. Now, let's get into it. The S&P 500 is clinging to its highs at $751.83, but the engine driving today's rally isn't broad market strength. It's a single 19% surge in PayPal. As we close out Wednesday, July 15th, the market is bifurcated. Megacap tech and a beneficiaries are soaring, while the broader tape, particularly small caps and defensives, looks increasingly fractured. The question isn't whether the indices will hold, but whether the foundation beneath them can support the weight. Looking ahead to the immediate schedule, our verified calendar highlights one primary catalyst for early Thursday morning. On Friday, July 17th, we face the monthly options expiration, or OPX. Historically, this date amplifies gamma exposure and can accentuate volatility in both direction and range-bound chop. With SPY currently trading near its 10-day high, the expiration mechanics will likely serve as the final test of support at $748.66 before the weekend. Beyond that, no additional macroeconomic releases or central bank decisions are scheduled in our verified window, leaving the market entirely focused on individual corporate developments and flow dynamics. Let's establish the baseline. Broader market indices are mixing, but the dispersion is telling. SPY is up 0.3% to $751.83. QQQ is stronger, gaining 1.12% to $719.69. But look at the breadth. Diamonds is virtually flat at $524.69, and IWM is barely positive at $294.51. Meanwhile, the sector ETFs reveal a stark rotation. The technology sector is leading with a nearly 1.3% gain, while the healthcare sector is down almost 2%. The narrative is dominated by the PayPal acquisition news and BlackRock's earnings, creating a winner-take-all environment. Apex, walk us through the structural integrity of this move.
It's a liquidity-concentrated rally, narrator. We aren't seeing a tide lifting all boats. We're seeing specific vessels being pulled up by the strongest currents. The data shows capital flowing exclusively into megacap tech, the technology sector, and financial services, the financial sector, specifically the and a play in PayPal and the institutional confidence signal from BlackRock. This creates a fragile equilibrium. SPY is propped up by heavyweight names, while the average stock, and certainly the small cap, is being left behind. The VIX at 17.16 tells me the market knows this divergence is risky. We are in a long but alert state, where the upside is real but the downside risk is being actively hedged by options traders.
Three headlines are defining the tape right now. First, PayPal is up 19.3% to $56.53, following a reported $53 billion takeover bid from Stripe and Advent. Second, BlackRock has reported Q2 earnings that sent shares up 5.5% to $1,081.62, driven by record AUM growth. Third, healthcare is under siege, with Elevance Health gapping down 7.5% to $394.97, dragging the healthcare sector lower. Let's get the pulse check on these moves. Pulse, where does sentiment stand?
It's completely split. On the PayPal side, you have extreme, almost irrational fear of missing out. The pre-market volume is screaming because retail and algorithmic traders are chasing the and a premium. But juxtapose that with the VIX jumping 2 points to 17.16. That spike means the big players aren't fear of missing outing. They are hedging. They know that a 19% gap up is unsustainable without massive volume follow-through. And on the healthcare side, it's capitulation. Elevance down 7% in the dark isn't a glitch. It's a sign that defensive safety nets are being shredded. The sentiment is buy the rumor for fintech, but sell the truth for healthcare.
And that's the danger zone, Pulse. You're calling it fear of missing out. I'm calling it a liquidity trap. The VIX spiking to 17.16 while the market closes green is the classic signature of a priced-in trap. The market is ignoring the fact that the 10-year, 2-year yield curve has flattened to plus 0.40 percentage points. You don't get a 19% surge in a single name on a flattening curve without expecting a mean reversion. The hedging you see in the VIX, that's smart money trying to escape the very volatility the headlines are celebrating.
Let's zoom in on the primary mover, PayPal. Trading at $56.53, it's up 19.3%. It's dragging the financial sector higher, with the financial sector up 0.2%. Grid, what are we seeing in the structure here?
Technically, this is a vertical impulse. $56.53 is far outside the normal 10-day range of this asset class. Usually when you see a gap this wide, you either fill it immediately or extend. Given that the bid is $53 billion, the price discovery is happening rapidly. There's no traditional technical support level to watch yet because the previous day's close is irrelevant. The only metric that matters is volume retention. If this price holds above $55 on high relative volume during the open, the short squeeze on the shorts continues. If it dips below 54 with fading volume, we'll see a rapid retracement toward the pre-gap levels.
From a flow perspective, this isn't just speculation, it's institutional reallocation. The bid from Stripe and Advent represents a massive capital injection. Look at the correlation with BlackRock. BLK is up 5% on record AUM. These are two sides of the same coin, institutional capital seeking yield and control. The money isn't just buying PayPal stock, it's betting on the consolidation of the digital payments ecosystem. The flow data shows heavy block trading in the pre-market, suggesting that large funds are positioning for the spread capture between the current price and the $53 offer. This is a fundamental shift in the competitive landscape for fintech.
But CIPHER, you're focusing on the bid and ignoring the counterparty risk. A $53 billion bid assumes integration success. With the yield curve flattening and the Fed holding rates at 3.63%, the cost of financing such a deal is rising. If credit markets tighten, which the VIX spike suggests they might, the bid structure could fracture. You're looking at the upside. I'm looking at the fragility of the transaction itself. If the bid wavers even slightly, the 18% premium evaporates instantly.
Exactly. And the sentiment skew on the puts versus calls right now, it's terrifying. Most retail buyers are buying naked calls, hoping for the moon. But the institutional put volume is spiking. The smart money is buying insurance. If I were trading this, I wouldn't chase the open. I'd wait to see if the $54 level holds as a new base. Until then, this is a casino chip, not a bond.
Speaking of institutions, let's talk about BlackRock. It's up 5.5% to $1,081.62 on strong Q2 results. CIPHER, how does this fit into the broader market thesis?
BLK's performance is the anchor for the risk-on argument. Record AUM growth means net inflows are healthy. Investors are putting money into active management and passive products alike, trusting these giants to navigate the current volatility. For the broader market, BLK's strength validates the financial sector's role as the gatekeeper of capital. It's a vote of confidence in the banking system's ability to handle M and activity. This supports the financial sector thesis. We are seeing a rotation from defensive holdings into financial intermediaries that facilitate growth.
On the chart, BLK is breaking out of a multi-week consolidation. $1,081 is a decisive close above the previous high. The volume profile shows accumulation over the last 3 days, culminating in this earnings-driven push. There's no overhead resistance until you get back to all-time highs. This is a textbook continuation pattern. Unlike the gapped move in PayPal, this is a sustainable technical breakout based on fundamentals.
And that's the contrast we need to highlight. Grid is right. BLK is a clean technical breakout backed by flow data. PayPal is a volatile gap-up backed by a merger arb. BLK provides the stability that the broader QQQ needs to hold $71.69. Without that kind of institutional anchoring, the tech-heavy index would be much more susceptible to the volatility SPECTER is warning about. BLK is the ballast. PayPal is the sail.
Now, let's pivot to the other side of the ledger. Healthcare. the healthcare sector, is down 1.93% today, and Elevance Health ELV is down 7.5% to $394.97. CIPHER, what's driving this sector sell-off?
This is a sector-wide repricing. ELV's move isn't isolated. It's a symptom of a larger shift away from low-beta defensives. In a risk-on environment where capital is flooding into tech and plays, defensive sectors become liabilities. Their yields are less attractive, and their growth prospects seem stagnant compared to the AI and fintech narratives. The fund flows show a deliberate liquidation of the healthcare sector holdings to free up margin for higher growth opportunities. This isn't necessarily bad news for the economy, but it is bad news for the defensive portfolio construction.
Or CIPHER, it's a warning shot. Healthcare is often the canary in the coal mine for regulatory risk. If investors are dumping ELV and the broader sector, they may be anticipating regulatory crackdowns or policy shifts that disproportionately affect payers and providers. Pair this with the flattening yield curve, a classic predictor of economic slowdown, and you have a scenario where consumers cut discretionary spending, hitting healthcare utilization rates. The VIX spike we discussed earlier. Part of that anxiety is bleeding into the health sector. It's not just rotation, it's fear.
Technically, the healthcare sector is broken. The breakdown below the recent support level on ELV is severe. 7% in pre-market is a structural break, not a noise fluctuation. The relative strength line between the healthcare sector and SPY is diving. Unless ELV can reclaim the $39 area quickly, the technical damage is done. The path of least resistance for the sector is lower, unless the broader market turns sharply defensive, which the current data doesn't support.
This brings us to the bread and butter of the market: SPY, QQQ, and IWM. SPY is at $751.83, QQQ at $719.69, and IWM is lagging at $294.51. Grid, is this rally sustainable with such poor small-cap participation?
No, it's not sustainable in a vacuum. The SPY rally is narrow. It's relying on the top 5 constituents to carry the index. The 10-day range for SPY is $748.66 to $753.34. We are sitting near the top of that range, but with diminishing breadth. The IWM is stuck in the lower half of its own 10-day range, 290.68 to 302.72. If SPY tries to break the $755 resistance, and IWM doesn't join in, we will likely see a rejection. The technical evidence suggests the rally is exhausted unless breadth expands. We need to see QQQ push toward its upper bound of $737.62 with expanding volume. Otherwise, it's a dead cat bounce.
Agreed. The sentiment indicators for the broader market aren't aligning with the SPY price. Retail interest is concentrated in the few and stories. The general fear and greed index is skewed by those outliers. The average trader is confused. Are they buying the dip in tech, or are they hiding in bonds? The confusion is visible in the volatility. The market is waiting for a catalyst to pick a direction. Right now, it's paralyzed by the divergence.
And that paralysis is dangerous. When the market is this divided, tech soaring, defensives crashing, small caps flat, it becomes highly sensitive to external shocks. The flattening yield curve is the shadow in the room. If bond yields move even slightly against equities, the fragile technical structures in SPY and QQQ will collapse. The VIX at 17.16 is a scream, not a whisper. It's telling you that the easy money has been made and the hard part is starting.
So to synthesize, we have a high alpha environment for specific names, PYPL, BLK supported by strong flow data and technical breakouts, but a low beta environment for the broader index. The risk is that the quality trade becomes crowded. Grid's concern about SPY rejecting at 755 is valid, especially if SPECTER yield curve warnings materialize. My recommendation is to ride the momentum in the confirmed leaders while strictly managing risk on the broader index exposure. Don't chase the breadth, don't yet.
That's the takeaway for today. The market is a tale of two halves: a euphoric M and A-driven rally in fintech and megacap tech, anchored by strong institutional flows in financials, and a crumbling foundation in healthcare and small caps, highlighted by widening volatility. The data shows us that SPY is holding its ground, but the footing is slippery. Key levels to monitor are SPY's support at $748.66 and Triple Q's resistance at $73.62. Tomorrow, we turn our attention to the monthly options expiration, which will test the durability of these ranges. Stay disciplined, watch the breadth, and let the data guide you. This is ShadowQuant Equities Edition. Thank you for listening. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Equities. Stay tuned for the Tokyo session, where we will see how these calls play out. Until then, trade safe.